Long-term care. The risk is very real. What are the chances that you or your spouse may go into a long term care situation? It's highly probable that one of you will. And so you may want to be thinking about long term care insurance. Today, Raiden and I are going to talk to you about the differences between traditional long term care and a hybrid long term care insurance policy.
So today on Wednesdays, it's Retirement in Action, and we have gotten a lot of good feedback, and we would love to hear from your feedback. So if you ever would like to reach out to us, we certainly would love to hear from you. You can do that a couple of different ways. You can go to our website, which is pomwealth.net, and you can send us a message. You can be able to email us or contact us. We'd love to hear from you on that. But we want this show to be the best it can be, and we love to hear your feedback. So if you don't mind, could you please go, if you're listening, especially on iTunes, give us a 5-star rating and a written review. It certainly does help us to make this a better show. But for today, we hope we're going to bring you a great show and help you to understand the differences between hybrid and traditional long-term care insurance. Enjoy the show. We are excited to have you with us another day for here on our podcast, Retirement in Action. We love these shows on Wednesdays, Merce and I do, because we get to talk to you about topics that people have to have in their life every single day, or at least what they think that they need to know about every single day as they are getting ready for and living through retirement. And today we're going to talk about long-term care insurance. Now you might think, well, that's not that exciting, and it may not be, but it is something that we need to discuss. And so we want to go through that with you. But before we do, we have to do what we all have to do in this world of finance, and that is to give you a little disclosure. So Merce, can you disclose what we need to disclose?
Yeah. So everyone, I hope you know that the information contained in this podcast is intended to provide general information only and not to be considered as individualized advice. Different types of investments carry different types of risk. Please contact your financial professional for advice appropriate to your specific situation. That's just one of those things that we got to say so that we can keep delivering you this fantastic content.
Okay, so let's talk about this. Now, here, when we talk about long-term care insurance, or let's just say it this way, we're trying to plan for what if we get into a scenario where we have to have long-term care in our life. Now, long-term care could be, I need assistance at my house. I need assisted living. I need somebody to come in and actually help me around and help me within the context of getting around, maybe taking a bath, maybe, getting my food, doing whatever I need around home. Then there's the element of I go into a facility, maybe I go into an assisted living facility, and then things can develop into a scenario where I might need to go into, in all essence, a nursing home, full-time medical care. So the question comes to us quite a bit is that what should we do about this? How should we cover it? And what has been around now for quite a few years is what is called, we refer to as traditional long-term care insurance. But then after that, there were these things called hybrid long-term care insurance plans. And so what we want to do is kind of just give you the picture so that if you're thinking about what do I do for long-term care, if I want to transfer some of that risk to an insurance company, how do I do that? And by the way, what are my options? So the whole purpose of this show today is to break down what those options are. So the first thing we're going to do is, if you've not looked into it, we're going to kind of give you what is traditional and then what is hybrid. So Merce, can you take us through the traditional look of what a traditional long-term care insurance policy looks like?
Yeah. And I think you said it perfectly when you said transference of risk. I mean, that's in all essence is what an insurance company is there for. Think about your car insurance. You're buying that to protect you in case something happens. You may never use it. You may use it seldomly. Think about homeowners insurance, life insurance. All it is, it's a personal decision as far as how much risk you want to transfer to an insurance company to cover what could happen in the future that you don't know about. So traditional long-term care, it's a standalone policy. And there are a few pieces that are interchangeable when you're thinking about buying a traditional long-term care insurance policy. So the most common way that it is done is that you're gonna pay a monthly or an annual bill to the insurance company to stay what they call in force, so to stay up to date with the insurance company, and that can range as far as what the premium is, and the premium is based off of some decisions that you make. You're going to make a decision if you're going the traditional route. You're going to make a decision of how much benefit do you want on a monthly or a daily basis. How much of that risk do you want the insurance company to cover? The lower benefit that you choose, obviously, the lower your premium is going to be. The higher, the more you want to cover, your premium is going to go up. Typically, you're seeing the monthly benefit to be around $3,000 a month to $12,000 a month. In that's what the insurance company is going to cover. So that's number one. Number two is you have a choice as far as what your benefit period is going to be. So do you want to cover 100% of the unknown of long-term care? And what I mean there is, well, do you think if you are in a long-term care situation, do you want to make sure that the policy is covering every single year for the rest of your life, if that's how long you're in long-term care? Or do you just want to cover a couple years? Is it 2 years, 3 years, 4 years? And so you have a decision to make as far as the duration of how long the policy can cover those bills. The third piece is inflation. This one's actually really important because let's say you go into you buy a long-term care policy today, and it says it's going to cover $3,000 a month if you qualify for the situation, and you buy it today, but you actually don't go into long-term care in 10, 15, 20, 30 years from now. And we all know inflation is there, and the cost of long-term care is going up. The cost of medical coverage is going up. And so we want to make sure that we have a policy that is going to keep up with the times in all essence. So there's an inflation protection that's built into these traditional policies. You can choose 3, 4, or 5% as a compounded inflation rate. So let's say you have that $3,000 a month benefit, and let's say you buy it this year. Next year you go into long-term care, and as long as you qualify, let's say you've got that 5% inflation. That means next year they're going to cover about $3,150 versus your original $3,000 that you signed up for. So you want to make sure if you're going to do these, you want to make sure that you've got some type of inflation to them so that you're keeping up with the rising cost of care. And then the last period is kind of like a deductible. It's called a waiting period, and this is also pretty important. It's essentially a period of time in which once you go into long-term care, or once you've been approved for long-term care, there's a window of time where you have to cover the expenses before the long-term care insurance actually kicks in. Typically, it's about 30 to 90 days, kind of like a deductible on car insurance. Car insurance says, well, you have to pay the first $500 before we'll actually start paying for any of the damages above that. Long-term care is pretty similar in the sense that they say, well, you have to cover the first 30 days or the first 60 days or the first 90 days, and then our long-term care insurance will kick in. So you kind of have to think about, well, how much risk do you want to cover there? Because the cost can rack up pretty quickly on a monthly basis. So those are really the four main things that you can manipulate as you're thinking about traditional long-term care insurance and whether or not it's right for you. Each one of those is kind of a knob that you can turn, and then it's going to result in a premium that could be relatively low, or it could take the premium up quite a bit. So traditional long-term care, one of the positives is that it can be custom tailored to whatever you're looking for, how much risk you want to cover. Obviously, there's a premium that you're paying. And the thing about traditional long-term care that we see the most is, you get down the line, maybe you start the policy back when you're in your early 50s and you've paid in thousands of dollars every single year for this policy, and you keep going down the line and you've amassed a lot of money that's gone out to the insurance company. But the thing is, with traditional long-term care, there is no cash value. So you're paying in just like to car insurance, just like to homeowners insurance, you're paying in, but you're not building up anything there. And so it's one of those things where, once again, you're trying to decide how much risk you want to cover. And that's part of the deal when you're doing insurance in general. There are some companies out there that will allow you to pay some of the traditional the premiums up front, but the majority are paid on an annual basis, and they continue as long as you're using the policy. The nice thing is that once you have been approved for long-term care insurance, they can't really reject you, or they can't turn your long-term care insurance off as long as you're making your premiums, as long as you're paying into it, then you're good. What's not so nice, and what we have seen in the past with clients and conversations, because of the rising cost of healthcare, long-term care, you will see rising premiums. I say will, I mean, I don't know the future, but what we have seen in the past is that we have seen every 3 to 5 years, you'll see your insurance premiums go up a little bit. And it may get to a point that when you're in your 60s, 70s, it may start to get a little bit too expensive for what your cash flow is. And so we've had that conversation from time to time with clients about, whether or not the long-term care traditional still makes sense. What can we do there? What's nice is that there is still some flexibility. So let's say your premium has gone to a point to where you can't afford it anymore, or you just don't want to pay for it anymore. Well, you've got two options. You can stop paying and lose the long-term care insurance and just cover long-term care yourself with your own assets, no insurance involved. The other option is to reduce some of your benefits. So you could reduce how much long-term care is going to pay for you. You could reduce the benefit period, so the duration, and you can reduce inflation as well. So there's some things in there that you can do to reduce what your overall premium is going to be, as we have seen these premium increases over the past 5 or 6 years. So there's a little bit of flexibility there. But at the end of the day, I think it's really important to understand what options are out there. That's a very high level as far as what traditional long-term care insurance is and why you may want to think about it. But I think, understanding the difference between traditional and what Radin is going to talk about, which is a hybrid long-term care plan in all essence. Our goal is to help you understand those two today, so that maybe you can make a decision, or even just start thinking about which one may be right for you, and we can help you down that path as well. So Radin, if you would, let's talk about how the hybrid works and the benefits of that.
Okay. So now, before I go into the hybrid, I do want to say this, for either one, whether it's traditional or hybrid, the qualifier to get the benefit is virtually the same. There are what are in these insurance policies, what are called 6 activities of daily living. And those 6 activities of daily living are bathing, dressing, eating, transferring, toileting, and continence. And the way that the trigger works is to say whether or not you're going to get the coverage to kick in, usually is if you need assistance with 2 of the 6. So that would then mean if you only have 2 of those things that you need help with, and a doctor says you need help with that, that will kick the insurance in and allow it to start paying. Now, what Merce has described is this idea of what is called traditional insurance, basically just giving us the insurance. And the thing that people hate the most about that insurance is that you might pay the premiums for 10, 15, 20, even 25 years. And if you are one of the fortunate ones who never need long-term care, then you paid premiums all those years and in all essence got no benefit. You just got the peace of mind knowing that you might have it covered if you needed it. And so many people have said, do I really want to pay for something that I don't know if I'm going to need it? And so that made the insurance industry, hearing that complaint, create what are called hybrid policies. And it took away a lot of that conversation. So I'm going to just give you a high level of 2 different types of hybrids And that'll help you to appreciate how you could do it a little bit different. First of all, the first hybrid is a long-term care annuity hybrid. Hybrid means we take two different types of insurance policies and we put them together. So you've got an annuity. It means I put my cash to work in the annuity. I'm going to get an interest rate. I can go take my cash anytime I need it. All good. But then I put on top of that a long-term care rider or benefit. So typically, now I'm going to use some really round numbers. I just want you to kind of get a visualization here of what it looks like. Let's say that I said I want to have some coverage for my long-term care. And let's just say I took one of these hybrids and I put, let's just say $100,000 into the annuity. So now the $100,000 is still my money. If I earn, let's say 3%, I'm earning it on the 100,000. If I decide I want to take money out, I can take money out. So I still have all the privileges of having that 100,000 in my possession. But what the long-term care of side of things would say is, and again, I'm just making up numbers here, is let's say maybe, depending on our age and our situation, 3 times that number could be used for long-term care. So I put $100,000 in, I have $300,000 of long-term care benefit that could be taken out over a number of months to help me with my long-term care. The advantage is, compared to the traditional, is let's say I put my $100,000 in, it earns 3%. I leave it in there for 25 years, the same as I would the traditional. It's earned 3% for all 25 years. I die. I never needed long-term care. My beneficiaries get the $100,000 plus the 3% compounded rate of return that occurred over that 25-year period. So a lot of people said, wow, that's way better. I didn't take the money out of my estate. That just gave me a lot of advantages. And so I don't have to also worry about rate increases on long-term care like I would on traditional. And so that was very, very popular and is very popular to cover long-term care. But now there's what would call a triple hybrid, which means it has 3 things. It's life insurance, cash value, and long-term care. So again, go back to the scenario. I say, hey, look, I don't know what I'm going to need here. I kind of like having compound on my money from a life insurance perspective. So let's say I put $100,000 into this plan. Now I might have $250,000 instantly of death benefit that could go to my heirs completely tax-free. I might have $300,000 or $400,000 of long-term care insurance, and maybe I've got some cash value that I can go get as well. And it won't be, if I put it in it right in the beginning, it probably won't be quite 100,000, but it'll be close. And so I kind of have the best of 3 worlds in there. And so again, if I were to pass away, my beneficiaries get the money tax-free. If I need the long-term care, I can do it. And if I need cash, I can go take my cash. The key, I think, between those 2 hybrids is that I have a couple things of an advantage. Number one, if I don't need the long-term care, my beneficiaries get a benefit. The second one is I don't have to worry about rate increases because these premiums are fixed. They're guaranteed for the period of time that they're in. And because of those things, when you compare those things to traditional, a lot of people have favored the hybrid over the traditional. And a lot of folks that work within long-term care exclusively have kind of transitioned much more toward that hybrid box. Now, there's a lot here. There's a lot in this conversation. There's a lot of things to consider. There's the factor of whether or not you should self-insure, meaning do you have enough money that you don't need long-term care? There's the idea of affordability. Can I put this money to the side and call it long-term care planning? So there's a lot there to consider. We know that. So Merce and I are never trying to talk on these podcasts and say, hey, everybody should go get long-term care. That's not the case. We do know that it is a conversation that you might want to have. And so we encourage you that if you wanted to talk about this and you wanted to try to figure out, is this right for you or not, we encourage you to have a conversation with us. You can simply go to our website, which is pomwealth.net. So POM for peace of mind, wealth.net. And right at the top of the page there, you're going to see a button that you can click on that says you can have a 15-minute consultation, phone consultation with either myself or Merce, and we are glad to talk about this with you. It is no obligation. There's no money to do this. It's just a 15-minute phone conversation. It's a way for us to talk about your personal situation as to whether or not it's something you might want to explore further. So if you want to do that, go to our website. Feel free to click on that. The calendar is going to come right up, and you can schedule a call with us based on your schedule and our schedule. So if you would like to do so, go do that. We do appreciate, though, you coming and having this conversation with us each and every Wednesday with what we call Retirement in Action. We hope you have a great day, and we hope this has been of some benefit to you.